Welcome investors, and today we're diving into a fascinating memo by Howard Marks, co-founder of Oaktree Capital Management.
In order to outperform, by definition, you have to depart from the crowd. You have to hold a different position, and you have to have resolve to do it.
Simple buy, sell, risk on, risk off questions. Why do you find such questions so deficient?
I think they're really superficial, and these are important matters, can rarely be answered simplistically. In order to be confident in giving buy-sell advice,
as I said, I've read everything you've written over the years, and I wanted to thank you personally for sharing all those thoughts, because they've been hugely instrumental in me being able to build my own framework. And that's a lot of what I want to talk to you about today is how you think as well as what you think.
Even if you are a passive investor, this letter is packed with wisdom that can reshape your approach to finance and life. Marx, known for his market insights, challenges our notion of certainty in an uncertain world. Let's explore why his perspectives are invaluable for every investor. Marx kicks off with a powerful anecdote about political predictions. He quotes Ron Klain, a former Biden chief of staff, saying about Biden's campaign chair, "She doesn't have any doubt." This leads Marx to ponder, how can anyone be truly without doubt, especially in such an unpredictable field as politics? He shares another example of misplaced certainty. An acknowledged expert in foreign affairs told the group I was part of there was a 100% probability that the Israelis would take out Iran's nuclear capability before year end. Marx notes that this prediction made around 2015 has yet to materialize. It didn't happen. This example serves as a potential reminder that even respected experts can be dramatically wrong with expressing absolute certainty. The core of Marx's argument is that macro forecasters simply cannot account for all the variables that will affect the future. There are known factors, but also random influences that are impossible to predict. Given this reality, Marx advises investors to be extremely cautious about using absolute terms like will, want, has to, can't, always, and never. This cautionary approach isn't just about semantics. It's about cultivating a mindset that acknowledges the inherent uncertainty in complex systems like markets and economies. By doing so, investors can make more nuanced, flexible decisions that account for a range of possible outcomes. Let's look at some high-profile prediction failures after you press the like button. First, 2016 United States presidential elections. Most experts were certain Hillary Clinton would win. Many predicted a stock market collapse if Trump won. Reality check. Trump won and the stock market rose over 30% in the following 14 months. This dual failure of prediction underscores Marx's point that we not only struggle to predict events, but we also fail to anticipate how markets will react to those events. And the second was Federal Reserve's transitory inflation view. In 2021, the Fed believed inflation would be temporary. By 2022, they had to embark on aggressive rate hikes. They defined this as temporary, not entrenched, and likely to self-correct. However, inflation proved more persistent than anticipated, forcing the Fed to embark on one of the fastest programs of interest rate increases in history. This miscalculation had profound implications for the economy and markets. Third, recession predictions. In mid-2022, experts were sure rate hikes would cause a recession. As of 2024, no recession has materialized. The economy has shown remarkable resilience, defying widespread expectations. Marx quips, "The only thing worthy of certainty is the conclusion that economists shouldn't be expressing any of it." And this section powerfully illustrates that even those with access to the best data, sophisticated models, and years of experience can be wrong, guys. Often dramatically so. We should approach predictions, including our own, with healthy skepticism. Now let's get to the juicy part of this letter. Why are markets so unpredictable? Marx provides this fascinating data that illuminates the unique volatility of financial markets. This data reveals that stock prices fluctuate far more dramatically than the underlying economic factors that supposedly drive them. But why? Marx argues that this heightened volatility is due to the critical role of human psychology in market behavior. While economic and corporate performance might follow somewhat predictable patterns, what Marx calls mechanical forces, markets are subject to the emotions and shifting sentiments of their participants. He explains that financial theories often assume market participants are pure irrational actors, homo economicus, who make decisions to maximize their financial self-interest. However, reality is much messier. Investor sentiment can swing wildly, often overwhelming the influence of fundamental factors, especially in the short term. This psychological element introduces a layer of unpredictability that makes accurate forecasting extremely challenging. As Marx puts it, relatively few market forecasts prove correct, and fewer still are right for the right reason. So next time you're tempted to follow a sure thing stock tip, remember Howard Marx's words. Marx draws on some heavyweight thinkers to support this case. John Kenneth Galbraith said, "There are two kinds of forecasters, those who don't know and those who don't know they don't know." Mark Twain quipped, "It ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so." Marx defines intellectual humility as the ability to say phrases like "I'm not sure," "the other person could be right," or "I might be wrong." He considers this trait essential for investors and decision makers in general. He offers this piece of wisdom: no statement that starts with "I don't know but" or "could be wrong but" ever got anyone into big trouble. The power of this approach, according to Marx, is that it encourages more thorough investigation, double-checking of conclusions, and proceeding with appropriate caution, like I do. While this might lead to some missed opportunities during good times, it also provides significant protection against catastrophic errors. Marx concludes this section with a powerful quote from Voltaire: "Doubt is not a pleasant condition, but certainty is absurd." Conclusion: embrace uncertainty. It's an inescapable part of investing and life in general. Be highly skeptical of anyone expressing absolute certainty, especially in complex fields like economics and financial markets. Cultivate intellectual humility. The ability to admit uncertainty can protect you from costly mistakes. Remember that even respected experts can be wrong. Diversify your sources of information and opinion. Focus on what you can control and be prepared for unexpected outcomes. As Marx concludes, there simply is no place for certainty in fields that are influenced by psychological fluctuations, irrationality, and randomness. By internalizing these lessons, we can become more thoughtful investors and decision makers also, better equipped to navigate the inherent unpredictability of markets and life also. So thank you for watching. If you found value in these insights, please like and subscribe for more investment philosophy content. And remember, in the spirit of Marx's teaching, approach the markets and life with a healthy dose of humble uncertainty. Happy investing, and you can see my performance as portfolio manager also, who is beating S&P 500 here. Thank you. Don't forget to click the like.